We'll get going here. I want to first thank you all, everyone who's registered and watching this recorded, and especially everyone who's live right now. Thank you so much for joining me for cash flow planning for 2021, capturing opportunities and dodging traps. This is actually the first webinar for CFO Perspective, and I'm hoping to be able to do a few more of these going into 2021. So what I'm going to do is I'm going to talk a little bit about cash flow planning. I'm going to talk a little bit about ACE, which is my strategic planning program, and then I'll open it up for questions. In total, this may go about an hour, and then I'll email the slides after the webinar. There were links in the reminder emails I sent that had the webinar slides in them, and also in the group chat, I just put in the link to the slides too, so you can download the PDF of the slides if you want to take notes or follow along. First, just a quick reminder and disclaimer, I'm a CPA, so I love this sort of stuff. And it's just a reminder that I'm going to be giving some general information, but everyone's situation is unique. And so before you really do anything huge, you want to talk with the appropriate legal, tax, or personal financial planning or investment advisor on these sorts of things. And really the heart of cash flow planning is about really thinking through things before you commit too much time and money and make big losses. So this webinar, this is for you. If you're tired of the stress of cash flow surprises, and surprises in quotes, meaning that they're usually the negative sort of surprise, not like, oh, wow, I had way more money than I thought. The other is that if you're tired of the stress, or if you're missing opportunities, or if you're slow to capture opportunities, or maybe you made a significant change to your business in 2020, and really, I mean, what business didn't have some major change in 2020? It's just been a massive year for change for all of us. The other is if you have ideas for your business for next year, but you really don't have a plan. So you're hoping it's going to work, but you really haven't done the financial planning to say, do you really have a business idea or just a hope and a dream? Well, what I want to say is that you're not alone. In fact, you're the majority. Because let's talk about missed opportunities. More than half of US businesses have lost $10,000 or more by foregoing a project or sale specifically due to issues created by insufficient cash flow, according to a QuickBooks study. As far as stress goes, 69% of business owners have been kept up at night by concerns about cash flow. So what I'm going to do in this webinar is show you how to reduce your stress and be ready to capture more opportunities. You're going to have clarity on what it takes financially for your goals to become a reality. And we'll start preparing now for where you want to be in next year. And just maybe, when you do cash flow planning, you'll be able to find cash to distribute to you as the owner or to grow your business. So how am I going to do this? What we're going to do is we're going to walk through a cash flow projection example. And a cash flow projection is the crucial step to understanding your business's financial future. And I'm explaining how all this fits into strategic planning. Now, this isn't a big webinar on planning. I'm just going to focus on one piece of planning with practical step-by-step examples. But I'm going to be walking you through a cash flow projection and modeling of a sample company so you can see how I do this with clients. Of course, every client's different, but we'll be using a sample company that I created that I'll talk about in just a little bit. I'll show you resources and tools to do this too. And many are free and you can use them yourself right away. And I'll show you how to get some of those. Some are inexpensive courses for more detail and advanced tools. And you may watch this and decide you want an expert to walk with you side by side during the planning process and help you build your projection. And that's what ACE is for. It's a strategic planning program for small businesses. It's completely your choice about what you want to walk away with from this webinar. I want to show you the benefits of a cash flow projection, and whether you do it yourself with free templates or on your own or inexpensive templates from some of the courses I'll show you, or you want to do ACE for full coaching, it's totally up to you on what you want to do. You've got the full range of what you can do of completely free on your own to full having me help you and coach you. But no matter what, you're not alone without help. You can get tools and education to better manage your cash for less stress and more opportunities. So before we start, you may be wondering who I am. And my name's Rob Stevens. I'm the founder of CFO Perspective. And CFO Perspective provides financial consulting and education to small businesses. I've been the CFO of multiple companies. I've also been the director of operations of a company with $3 billion in assets. So I understand how companies fit together to work in even a fairly complex, larger company. I teach entrepreneurial finance to MBA students at Gonzaga University. And I also have classes on multiple CPA continuing education sites too. Over my career, I've ran hundreds of cash flow projections. I've built dozens of budgets and financial projections for business plans. And here's what I've learned: you don't know if you're walking into a gold mine or a bottomless pit until you run a cash flow projection. I can't tell you how many times someone has come to me with what they see as a great idea and the numbers just don't work. So you want to know that before you've wasted massive amounts of time and money. Other times we run the numbers and the plan works. What's even better is we have a clearer idea of what drives the profits and when we'll reach profitability, which is sometimes done in like a formal break even analysis of when we'll actually start breaking even and start making a profit. So now let's look at an example cash flow projection. So for the example I'll be walking through today, let's say I have a fictional company called Rob's Office Supply Company, or Roscoe for short. And what I do is I sell office furniture. Overall, the office furniture industry has been down about 20% in 2020. Plexiglass was hot, open concept was not. I mean, who knew in January that the future really was in plastics, specifically plexiglass? So sales were hammered and they're slowly rising out of the abyss. And I'm starting to hear that many companies are adding new office configurations to their budgets in 2021, which may be a great year for me. But see, what's happened is there's been an abrupt shift in what people want. Open concept and collaborative spaces are out, and people want more private spaces and hoteling spaces for remote workers when they're in the office, and more barriers and plexiglass. Soft surfaces are out, and easily cleanable surfaces are in. And businesses can't use their existing cubicles and furniture they've had for years for the new configurations they want. So all this points to a good year for me next year. So first, let's look at the basic info worksheet of my cash flow projection template. So this cash flow projection template, I've got a bunch of different versions. I'm going to talk about that in a little bit. But what we're going to do is I'm going to be walking through an example of my 36-month template for this example. And first, I'm just going to show you what 2020 is going to look like. Then I'll show you where you can get some of these templates for free or for inexpensively. And in the 36-month template, that template has 3 entry worksheets, one for each year. And so in this example, year 1 is going to be my actual results for 2020 with estimates for the last few months of the year. And year 2 is going to be my projection for 2021. And I won't be using year 3 in today's example. And we'll assume that I started 2020 with $48,720 of cash. And we'll also assume that I don't have a line of credit right now either. So all that gets entered in on this first entry basic info worksheet that I'm showing right now on the screen. Okay. Let me turn on my laser pointer so I can point at some numbers now. So first, we'll look at my cash from operations for the current year. Remember, this is actual results to September, and then I projected amounts after that for the rest of 2020. And I break cash into 3 sections on the template. And first is net cash from sales. And net cash from sales is your cash from your sales less the cash paid for goods to get the net cash from sales. And different companies can deal with this 2 different ways. Definitely if you're producing or manufacturing physical goods, that's your sales price less the cost paid for producing or buying those goods, things like that. But even for a service company where you really have direct labor associated with your sales, you could also have cash from sales with direct labor costs to get to a net cash from sales. Sometimes to get to a gross margin, even service companies will do that. The next is other cash flows, other operational cash inflows. And that's just for any other sort of cash inflows here. So like sales tax, that's not an income, but it is a cash inflow. And the reason you may want to track it is you may be collecting it every month, but only paying it to the state like once a quarter or once a year. So you want to track how it's accumulating and going out, partly because you never want to be dipping into that. And then when it comes time to pay the government, you don't have the cash to do it. And that's a big problem because if there's someone you don't want to mess with, it's the government when it comes to paying your taxes. The third section is the cash outflows from all other expenses here. And so the total of all this comes down together to the net cash from operations here. Now, I'm not going to go in today's webinar, I'm not going to go into all the different line items here that I have, but I want to point out a few of them that are important to the story of how this cash flow projection is working or not working, as we'll see. So what sales did is they followed what I call the COVID curve. And so the COVID curve was life was fine and dandy in January and February, and then the world just fell apart somewhere around March and April, and suddenly sales just dropped way off. And I couldn't do installations and office buildings because they were closed, and everyone started really pulling back big time and being very cautious. So sales went way, way down in the summer, and now they're just slowly starting to crawl their way out. And I expect them to slowly crawl their way back towards normal as we keep going here. Now, the biggest way that I held on to cash was that I stopped buying inventory. And so you'll see here that suddenly when the sales dropped way down, my inventory purchases are going way down too. And so that's how I managed to hold on to cash during this cycle here in 2020. But the issue with that now is my inventory levels are very, very low. I've been very conservative on my purchases, and that's going to play into my cash needs in 2021. Now, another thing too is usually aside from cost of goods, a huge, maybe, and for service businesses, the biggest expense are salaries. And so for salary, or for a lot of service businesses, it's salaries. So for salaries, I had 2 employees. I kept them on the payroll the whole time and took care of them. But I had contract labor that helped me with installations. I quit using them when everything dropped off, and I'm starting to pull them back in just a little bit to help with some of the installations here, but I didn't need them for most of the year. So the cash flow projection has the cash from operations that we just talked about, but it also has 2 other sections. One section are financing and investment cash inflows, and the other is financing and investment cash outflows. So I used to take an owner's draw every month of $5,000 a month. But when everything went crazy, I stopped doing that to help the company conserve cash. So from March through May, I took nothing. And then I slowly started ramping up, taking some draws. And I'm hoping by December, I'm able to get back up to $5,000 a month in owner's draws. So this is the example of when lenders look at a company and they talk about the owner being a source of strength or a source of weakness for a company. If an owner is strong personally and financially, they're a source of strength for the company, because then the company doesn't have to keep spinning off cash for the owner to subsidize their lifestyle. And so that means the company's got a better chance of holding on to its cash or positive cash during the hard times. Whereas if you have a company that hits hard times and can't produce cash, and you've got an owner that desperately needs the cash, then that creates a problem for the company. And what happens sometimes is the owners are pulling cash out of the company and the company just can't survive. So that's something that lenders look at as far as source of strength and source of weakness of the owner for the company. So now let's look at the analytics page. So the way that the cash flow projection works is there's that basic entry, the basic info page where you just put your company name and how much cash you have and whether you have any lines of credit. And then there's the analysis page. The analysis page just gives you a high level overview of what your cash looks like here. So we can see in the graph that cash was doing okay and then just craters negative here in March and April, then comes back out and does okay. September is going to be a rough month because of taxes. And then it looks like cash will be okay, but it goes back down in December here. And if I want, I could look at the detail in the table on that of how all this is fitting together. And I can also see how I handled it with my financing cash flows with my owner's draw of shutting those off. And then I can also see what like ending cash balances are and how they dropped and how they're starting to rebuild a little bit here. Now there's actually a whole other section on another section on this page, which is a line of credits. And it follows how much you borrowed on your line of credit and what you have available and things like that. I don't have that, so I didn't try to squeeze it onto the screen here. There's only so much space on the screen, so I didn't put that into this. So now that you understand what the template looks like a little, and we're going to get back to it and start going through 2021 in just a minute, I want to pause here just to talk about my to talk about where you can get some templates and things. So there's a free 6-month template, cash flow projection template, on the free tools page of my website. And if you're ever on the website and want to get to that, that's on the free tools page here. But all of you, anyone who's really subscribed for this webinar, then you're subscribers to the Weekly Insights emails. If you're a subscriber to the Weekly Insight emails, you have access to all of the tools in the small business toolbox. So it's just basically everything that's on the free tools page of my site. But if you go through my free tools page, you have to enter in your email each time you want to download something. On the small business toolbox page, you don't have to do that. You can download whatever you want. You don't have to enter your email in each time then, because you've already entered it in once, and we don't need to do that over and over again. And so when you first signed up for the Weekly Insights, you got a link to that. Every now and then in a Weekly Insights, I'll have a reminder link to it. And if you ever lose that link, just shoot me an email and I'll send you the link of how you get to the small business toolbox there with all that stuff. So you can just reply back to any of the Weekly Insights that comes back to me. So I also have some courses. They're really inexpensive. They start at $19 and go up to $99. The $19 course is a 12-month template. And then you could go up to a 36-month template. Now, the idea with the 36-month template, not only do you get 3 years, and so you could do like a year of actuals and 2 years of projections if you want, like I did, or you could do a full 3 years of projections, like for a business plan or something like that. But I customized the 36-month template to your chart of accounts to make it easy for you. And that really makes it customized. And sometimes, particularly on the 36-month with 1 hour of consulting here, in this one here for $99, you not only get the 36 months of the 36 months of projection, but you also get an hour with me on Zoom, and we go through it together. And I just kind of walk through it with you. And sometimes too, I end up doing more specialization of how the revenues are projected. I've done that a few times now, where people they want a little bit more granularity, a little more detail on how they project their revenue. So it's like, how many things are you going to sell each month times what do you charge for that? And it just makes it much, much more useful and customized to your company. Okay, now that we've talked about where you can get these resources, and there's really tons of resources in those free resources pages. I forgot to mention, you can get a KPI dashboard, which is a key performance indicators dashboard. You get a copy of my ebook on conquering cash flow. There's customer dreams worksheets, your aspirations and purpose for your company, just a cash conversion calculator, in addition to the simple 6-month cash flow projection. So there's all sorts of resources for you out there. All right. Before we actually look at the projections for 2021, let's talk about my assumptions for 2021. So what I'm hearing from my customers is that they'll need to do some significant cubicle and office changes next year. And they made some small changes in 2020, but now they're actually in the budgeting cycle for bigger changes in 2021. I mean, they basically just did enough to get by, and now they're really looking at longer term change on how their employees work. 2020 was rough for my business, and I dipped into personal savings to keep cash in the business. And the entrepreneur's mantra is, when in doubt, grow your way out. And so I'm going to grow next year. And so a lot of small business owners think that growth solves all their problems, but I'm going to show you why that may not be the case. So my inventory is very low right now, though, and I never stocked very much of the new types of furniture that I'm going to need in 2021. What people want, the demand, the interest is totally changed. So I'm going to need to buy a lot of inventory to be ready for the demand that's coming up in 2021. And part of the issue with me wanting to have more inventory too was that 2020 really weakened much of our faith in our supply chains. It was hard to get inventory. There were lots of back orders and shipping was slow. So I can't afford to lose out on sales and decrease customer satisfaction because I can't deliver the furniture. I'm going to have to hold on to more inventory than I have in the past, which further increases how much inventory I need to buy. All right. It's time to actually put some numbers to this and make my projections for 2021, which is year 2 of my worksheet. So I project that my sales are going to grow going into the first quarter and then just continue to grow. So I'm actually very optimistic for 2021 in my projection. But you see that I have negative cash even with those high sales because I'm really front loading inventory purchases. And so you can see what that massive amount of inventory purchases is doing is my cash flow gets drawn down very quickly from $44,000 positive to $5,000, and then it goes as low as $43,000 before it's I'm starting to get all these big cash sales to cover the cost of my inventory buildup that I needed to do at the beginning of the year. So that makes my operational cash flow negative. And it's actually so negative, I don't have cash to do the $5,000 a month for my owner's draws like I usually like to do. And, if I was tight on cash, I could maybe give up a bit for a while in 2020, but this may become a bigger problem in 2021 if I can't take my owner's draws. So now I suddenly see that I have a big problem and I need to find some cash. And this is the power of a projection. And let me explain why. I like to call the first draft of a projection the ghost of your financial future. And this comes from the story A Christmas Carol by Charles Dickens, where a series of ghosts visit Ebenezer Scrooge. And the last and scariest ghost is the ghost of Christmas future, who shows him the awful results of the life he's lived. Now, Scrooge faces a miserable future from hoarding cash, but many businesses, they face a potential miserable future because they're bleeding cash. And there are two major ways that businesses are surprised to find that they bleed cash. The first is growth. Growth creates more cash flow problems at first than it solves in the long term. And I'll explain why in just a minute here. The second way that businesses bleed cash are through cash leaks. So business owners or managers are usually focused on sales or growth or marketing or improving operations. And they don't notice all the small decisions that happen over time that create small cash leaks. So in my example, I likely challenged all my expenses in 2020 because of the huge drop in cash. And so I may have found ways I was bleeding cash and didn't attend to them until I was trying to just keep my company afloat. So these leaks were likely accumulating over all the good years, and they were quietly leaking cash and profits, but I never noticed them because my net margin was growing faster. But still, they were a drag on what I could have been earning all that time. So a projection or a budget once a year, that's the perfect time to find and stop all these leaks. So even when you think things are going fairly well, you can actually find even more profit and revenue improvement by just stopping and thinking about your operations and questioning some of your expenses once a year. Now, let's talk about why growth causes cash to go down before it goes up. So companies usually have a delay between the costs of production and the collections on sales. So like in my company where I have inventory, I need to buy the inventory before I actually install it and sell it and can collect it from my customers and get it back to cash. If you're a service business, you have to hire employees and pay them to do the work before you can bill the customer and receive the cash back from your customer here. So when you grow, your expenses go up before you actually collect on the larger sales on here. And so this delay in the cash conversion cycle is why you actually have a cash squeeze when you go through a growth spurt. And then companies that don't prepare for this literally die from lack of cash while they're reaching from the growth that can increase their profits. So it's this huge focus on profits, but forgetting the cash flow implications. The other surprising way that cash flow problems can happen is after a good year, actually. So the senior vice president of business services at a $2 billion institution I once worked at said, borrowers don't go bad 1 to 2 years after a bad year. They go bad 1 to 2 years after a good year. Because what happens is they build to a capacity they can't maintain in the long term. They can no longer handle their fixed costs. So fixed costs are like buildings or equipment or staff that don't rise and fall with your sales. So if your sales drop and those costs are fixed, your sales drop and maybe it's negative or maybe it's just you're not making any money there. So you can't easily reduce them when sales go up or when sales go down. So what you always want to do is you always want to run a base scenario of what you expect in sales. And usually it's a fairly optimistic scenario. Or at least most likely to an optimistic scenario. But always run an alternative scenario where maybe it's a little bit darker, a little bit more conservative on the sales where sales aren't as high, and just see if it's going to cause major cash drains. Is there any way you can reduce your costs in that scenario so you don't run out of cash? So it's always good to see, do you have the flexibility and what are your options if things get rough? And you may not make some major investments so that you have that flexibility if things don't turn out like you thought, but may happen. You have that flexibility to still maintain positive cash flow. All right, so what are my options for my imaginary company, Roscoe, in 2021? So I'm bleeding cash. I could reduce my inventory ramp up. And that definitely helps my cash flow, but it potentially reduces my earnings if I can't make sales and if I tick off my customers. And really, that's not a risk I'm willing to take. I could inject more cash into the company. I can make a loan to the company or invest it as equity. And that's a good option, but it may not be the best option in this scenario here. And I did something similar in 2020 when I stopped taking a draw. So instead of taking money out, I just stopped. I could go even further and put money into the company, but that may not be the best thing to do. I could raise equity from another investor, but that's not a good move for a temporary cash shortage. You don't want to give up a portion of all your future earnings for a temporary cash situation. Now, this is what happens when companies don't do planning is they get stuck and they end up having to sell a portion of the company to get the cash they need just to survive. But it's a long-term, a very expensive way to raise your funds. So the best answer may be a line of credit. So lines of credit are loans that can be drawn on or paid off at any time. For example, let's say I want to maintain $10,000 here, ending cash balance at the end of every month here. So in the first 4 months, I borrow $10,000 the first month, I borrow an additional $30,000 the next month, and another $28,000, another $5,000. So those are my draws on my line of credit. Now, what those do is those give me the cash I desperately needed to do my inventory buildup. Then once I've done with the inventory buildup and I'm starting to get strong sales and cash inflows, down here on pay downs of lines of credit, now I can start paying off that line of credit to pay it back down. Because what you need to do with a business line of credit is you have to pay it down to zero periodically, which is called resting the line. And how often you have to do this and for how long are in your loan agreement. But notice what I also was able to do was I was able to get enough cash to continue my owner's draws of $5,000 a month. And so I have solved multiple problems now by doing a little bit of cash flow planning. One, I figured out how to cash flow my operations. And two, I've figured out how I could continue to take my draws. Now, if I wanted to, I could be even more conservative and not taking $5,000 right away. I could have done slower or reduced my owner's draws at the beginning. Now you have two options for lines of credit: a business line of credit or a home equity line of credit, or a HELOC for short. Business line of credit, they're an excellent business loan choice for short-term cash needs. And you usually pay an annual commitment fee based on the commitment amount of the loan. So the commitment amount is the maximum that you can borrow at any one time. So for example, if your commitment amount is $100,000 and you're charged a 1% commitment fee, you would owe $1,000 for the ability to use the line, which could be advanced from the line. Interest is paid monthly, and it's based off of every day the bank or the credit union will calculate what your outstanding balance is times your interest rate divided by 365 days. So every day they're figuring out how much interest you owe for that one day. They sum it up at the end of the month and they give you a bill, and that's how much you owe each month for the interest. And you only have to pay the interest. The principal you can draw on or pay off whenever, but you have to rest it every now and then. So lines of credit they have a floating rate, which often floats with the prime rate as the index. So the floating rate means the rate can change whenever the index rate changes, and it could be on a frequent basis. It could change the next day after the index changes or the month after the index changes, things like that. So usually they try to pick an index rate that's used in the financial markets, like the prime rate. And it's usually plus or minus an amount to arrive at your total interest rate. So if you're a newer company, they may say, okay, prime rate, which is 3.25% plus 2%. So that means your total interest cost, your total interest rate is the 3.25 prime rate plus the 2% for a total rate of 5.25% there. And your line, it may be collateralized by your inventory or your receivables. And the companies are stronger financially. They can get unsecured lines because of the strength of their cash flow. And collateral is just company or personal assets that are pledged to the bank in exchange for getting the loan to reduce the risk to the bank. Now, a home equity line of credit is a second option, and it may be the right option for some people and some companies, and maybe the wrong one for some companies. So a HELOC is a line of credit collateralized by your house, and they can be first or second mortgages, but this is a personal loan, not a business loan. But a nice thing about a HELOC is there's usually no commitment fee. And the way they work is they have a draw period or a revolving period of 5 to 10 years when they're a revolving line of credit. And unlike a business loan, they don't have this resting requirement that the business loans do. But then they switch to a repayment period of 10 to 20 years. So they have a variable rate, like we talked about in business lines of credit, when they're acting like a revolving line, and then they're a fixed rate during the repayment period. But here's the big caution. You're putting up your house as collateral when you do this. So if you aren't able to pay off this loan, you risk losing your house. So this may be an option for solopreneurs or a couple that own a business. And I, like I worked with one client and it was an optometrist, and it's just him. And so it was a good option for him. But if you're talking about partners that aren't related, then business lines may be a better one for businesses with multiple owners. All right, so let's talk about planning specifically for 2021. Here are some ideas for 2021. Debt is very cheap right now. Rates have never been lower, and maybe a good time to get the lines I talked about, or it may be a good time to refinance any existing longer term debt you may have, like on your buildings. I talked earlier about how businesses get led into the growth cash trap of high fixed costs. And this massive shift to remote work has allowed businesses to test their ability for flexible work. It's really been a way for businesses to test alternative ways of operations models. The old model was you hire employees and they spend all day in a space you rent or buy. But some businesses are deciding they don't need as much office space as they currently have due to remote workers or flexible work schedules. And second, when work can be done anywhere, maybe independent contractors or freelancers are a better option than employees for some duties. So the best and cheapest talent may be in another city, but they can work effectively for you via the internet. In the independent contractors and less office space reduce those fixed costs we talked about and allow you to be more profitable in the downturns. But in finance, there's no such thing as a free lunch. So having employees may allow you to be more profitable if you really grow a lot or have great sales. So you have to balance the risks and rewards of staffing for flexibility in the downturns or staffing for profitability and growth. Finally, you need to be ready for tomorrow's challenges and opportunities. It was only 10 months ago in January that I was talking to a room of small business owners, telling them to be ready for a downturn. Now, I am not a prophet. I wasn't predicting when it was going to happen. And I was really clear about that too, but we all know that the economies go up and they go down. There's always economic cycles. And we have just been on a really long positive economic cycle. So at some point, things are going to turn. So little did any of us know how quickly and severely everything was about to change. So change, both good and bad, can happen quickly. And the stock market is an example of that. It had its shortest bear market in history this year. It lost 30% and then recovered that and even more in just a few months. And the larger economy is going to take a little bit more time to recover. I teach behavioral finance to MBA students at Gonzaga. I teach a behavioral finance class. Actually, next week I teach it. And a common mistake people make is called the extrapolation bias. And that's just a fancy term that means that we think about tomorrow is going to look like today or the recent past. In January, we may have overestimated the odds of good times like we'd had in the past. But now we may be overestimating the odds of tough times like we've just gone through, or that we may feel like we're going through right now. I like to say the deals are in the downturns. So flexibility is the key right now to weather a cash squeeze if we have to go through more shutdowns, or to grab opportunities from companies that don't have enough cash to survive. So sales are slower in downturns, but businesses change faster in downturns. When you aren't consumed with production and just keeping up with it, you can retool for the future. So the question is, as we're heading into 2021 and potentially going back to a different type of normal or better times maybe, what can you do now to be ready to profit when the good times return? So let's recap what I learned from the cash flow projection. If I hadn't done a cash flow projection, I may not have seen the cash crunch coming. I would have been dreaming of bigger sales and ordering inventory. I would have been totally clueless. Then I would have been scrambling. A few months later, when my cash starts going negative, the projection not only allows me to avoid that stress, I have plenty of time to get a line of credit if I need one. And for any of you who have gotten a loan, you know that it takes more time than you think to get a loan. And particularly if you're thinking about an SBA loan, they take a lot of time. So time equals options. The more time you have, the more options you have to get cash. And so doing a cash flow projection now gave me time to line up the funding I needed. I also know my business plan actually works from a cash flow perspective. I can show that it will likely produce cash. And this is important to me as the business owner, both for my business planning and for my personal financial planning when we talked about those owner's draws. It's also crucial if I'm wanting money from banks or investors. It's not just ideas in my head that I hope are going to work. But even if I thought I was profitable or I was really confident I was profitable, was I certain I had enough cash to pull the plan off? Because profits are not the same as cash. And so you can be profitable and still be bleeding cash. And we talk about that in the cash cycle too. So this also shows, yes, I have the actual cash in hand to pay the bills and pay my employees to make this thing happen. Now, my original plan didn't cash flow, it didn't have positive cash flow. And this is often the case. I've been through many budget cycles and built many projections where the first draft just didn't work. And the idea was okay, but the details of the plan, they needed refined for the profit and the cash flow to work. So often expenses need reduced or major purchases have to be delayed to make everything work okay. And so like my example, alternative cash sources may be needed and those take time to get. I also know when and if I can make distributions to myself as an owner. And this allows me to plan my personal finances. A cash projection is really where the rubber meets the road for your business plan. Having someone work alongside you to help with this, especially to explain your options and find solutions for better cash flow your business, is invaluable. And ACE is a cash is at the cash flow projection is the heart of ACE. So ACE is a strategic planning program that's tailored to small businesses. And it doesn't have a lot of the overkill of a lot of planning, and it's very affordable. I like to kid that strategic planning retreats and horror movies are stories about a group of people trapped in a cabin in the woods where they're slowly dying. At the last company I worked at, the strategic planning and budgeting process really started literally in a cabin in the woods every year. And so we'd start identifying some of the key things for the budget, some major strategies for the next year. And it really kicked off 2 months of this grueling budget process. Now, this is way overkill for small businesses. And that's why I've trimmed the concepts of strategic planning specifically tailored for small businesses. So I'll guide you through the basic steps of setting and implementing a strategic plan, starting with the big question of what do you want from your company and mapping that all the way to practical quarterly objectives and tasks to attain that purpose. And along the way, I'll give you tools to implement your plan. So I'll explain in plain English how you can improve your business as I walk you through this step-by-step process. And it's flexible, so we can work together to adapt it to your business. And you can always email or call me if you ever have any questions while we're working through these things. So think of ACE as like giving your business the ultimate compass. You get a cash flow projection, which is what we just talked about here. You'll identify your objectives, which are quarterly steps to achieve your plan. You'll set metrics, which is just a few key numbers just to look at, just to make sure you're on the right track and that you're not going off track and not really on your path to success. Purpose is to set a clear purpose and focused so that you're pointed in the right direction, not getting distracted around. And that's also alignment. Alignment is to make sure that every part of the plan is aligned to making sure that you're heading towards how you define success. So your efforts aren't scattered and ineffective. A SWOT analysis is a proven tool for assessing your company and your environment. An example of a SWOT analysis are some of the things I talked about when I made my assumptions for 2021 about Roscoe and what's going on in the industry and what am I going to need to do and what are my inventory issues. Also, this all comes together then as a strategic plan. All this comes together as a plan. So a strategic plan is just not something you create and then you do operations. Strategic plan is really you kind of thinking through the critical things that are going to set your path for your operations and your sales and your finances for the next year. And there's no risks to you. So if the course isn't everything you expected, you can leave within the first 30 days and get a full refund. I want you to be 100% satisfied with what you're receiving from me. Now, I know that for some of you, planning's like eating your vegetables. It's absolutely important to the health of your business, but it doesn't have to be drudgery. Here are some quotes from people that have worked with me. Rob has a self-effacing sense of humor, which is quite honestly disarming, and has managed to convince me that finance can actually be fun. Rob is passionate about helping business owners succeed, is intelligent and knowledgeable, and is a great communicator, facilitator, and teacher. And he does all this in a fun and an approachable manner. I can't thank you enough. Rob worked magic with all the moving parts we had in regards to our finances. Rob consolidated and outlined our financial strategy, leveraging the tools we were already using. It was like magic. We quickly and easily saw areas of growth that allowed us to make solid business decisions.